Venture capital financing can be really daunting for a lot of people, especially people that are outside of the VC ecosystem. So for most founders that are just starting a company, they have no idea where to begin whenever it comes to fundraising. I am just as guilty of this as anybody. Whenever I first started Forecastr, I was really at a loss for where to start, who to talk to, all of the different vehicles, everything. It was all very, very daunting for me. And I had to spend a lot of time educating myself, a lot of time talking to mentors, a lot of time talking to other founders, just to try to get my bearings, just to try to understand what should I do? Who should I talk to? What does all of this mean? So this inspired me to shoot a video to do my part in trying to demystify this thing called venture capital and this thing called venture finance. Specifically, I want to direct this to earlier stage companies that are just trying to get started, and they're trying to just understand what different terms mean, what they should focus on, who they should be talking to. And this is a massive, massive topic. So I'm going to do my best to just kind of scratch the surface here, maybe give you a good jumping off point. But I have an entire other video that's called How to Raise a Round of Funding Without Any Revenue. So you should definitely go check that out if you haven't seen it. But I want to orient this one around really just orienting all of us around what venture capital financing is and where to start. So kind of a very beginner's guide where to start looking at VC financing. So the first thing that I want to touch on are the different early rounds of funding. So I want to focus on early stage of the spectrum here. I'm going to be talking about pre-seed, seed, and Series A. So those are usually the three earliest rounds of funding. You may have heard some of these called friends and family rounds, angel rounds, things like that. So I'm going to try to demystify that as much as I can. So at the earliest, you're looking at a pre-seed round of funding. So this is a round of funding that is going to be relatively small, a couple $100,000, but it really depends. You've seen really, really big pre-seed rounds out there in the news as well, but it is an early round of funding that is generally meant to start getting a proof of concept built. It's usually meant to start building out some software, start showing that you can get some traction, that people are interested in what you're building, and that you have something that you can generally scale on. Now, whenever we're talking about a pre-seed round, usually the types of vehicles that we want to raise in, so that by vehicle, I mean how we want to raise that money, typically it is done through either a convertible note or a SAFE. So these are probably new terms. So I want to explain each of these. So a convertible note is essentially a hybrid form of debt and equity. So what I mean by that is a convertible note is technically debt, hence the name note. So it's like a note that you probably learned about in finance class, but it is different than traditional debt in that most of the time, pretty much all the time, you're not expected to actually pay that debt back. In fact, that debt is pretty much solely in existence in order to convert into equity at a later date. So why do this? Why is there such a thing called convertible debt? Well, the reason for this is that if you raise equity into a convertible note, into convertible debt, then you do not have to set a valuation for your company, which is another way of saying that whenever you raise into a convertible note, you are not agreeing to give away any specific percentage of your company at that point in time. Why is this useful? Well, if you're an early stage company, idea stage, pre-revenue, maybe just a little bit of revenue, it's really hard to value your startup. In fact, I did an entire video how to value your startup without revenue. It's very, very difficult, and it can be a very contentious point, and it's frankly scary for a lot of founders that are just getting started. So what a convertible note allows you to do is kick off that conversation until you go out and raise a traditional round of funding, which I'll get to here in a second, which will force you to value your company. So it essentially kicks the question of valuation down the road a little bit so that you don't have to agree on a valuation with a bunch of shareholders early on. So essentially what it's going to do typically with a convertible note is it's going to say, we are going to convert the amount of money that is raised into this note into equity at a discount to the next round of funding. So let's say that you raise money on a convertible note with a 20% discount to the next round of funding. Let's say that your next round of funding ends up being $10 million. Well, the investors in that convertible note are essentially going to get in at an $8 million valuation. So they're going to get a deal compared to the valuation of that next round of funding. They're going to get that deal because they invested in you whenever you are really, really early. So they're going to get a discount on that round of funding. So they're going to get rewarded for buying into your startup in the early days whenever it is relatively risky. Now, there's a such thing as a valuation cap, which is very, very traditional whenever it comes to convertible notes. What this essentially does is it sets a maximum for the valuation of your company. So let's say, for example, you raise a very, very early round of funding on a convertible note, and then the business really, really, really takes off, and you go out and raise your next round of funding, let's say at like $100 million valuations. Let's say you go out and raise your first round, you get it on a convertible note, your next round of funding is going to be at $100 million valuation. Well, the people that invested on you very, very early are probably not going to love that because they took a huge, huge risk on betting on you, and now your valuation's super, super high, and they're going to have to convert at that value unless you have a valuation cap. So let's say that convertible note has a cap of a $10 million valuation. That would mean that the people that invested in that convertible note really, really early on are going to hit that cap. So their money is going to convert at that $10 million valuation, not that $100 million valuation. So they have a little bit of a safety net there, so you're not going to outgrow that valuation. So those are convertible notes. That's generally how that works. And those are traditionally associated with angel investors. So these are high net worth individuals that are writing checks into companies. They're relatively straightforward to get done. They're very, very cheap, especially when compared to a traditional equity round. You can actually even print off a convertible note online. You can sign it and you can start raising on that convertible note, maybe with just a little bit of time from a lawyer. Very, very cheap, very, very easy. And you can do what's known as a rolling close on a convertible note as well, which means that as soon as an investor writes you a check, you can put it in the bank account and you can keep raising those funds, and you can spend the money that the investor gives you in order to grow the business while you're raising that round, which can be very, very enticing for a company that's really early and just needs a little bit of money to get the ball rolling while they continue to raise that next round of funding. I'm going to touch on safes very quickly, but they're very similar to convertible notes. So a safe stands for a simple agreement for future equity. It was born out of Y Combinator, and it's essentially, it functions a lot like a convertible note. The only difference is it's not technically debt. It will, though, convert into equity during your next round of funding. So it's not quite debt. It's not quite equity. It's just kind of this hybrid instrument, but it behaves a lot like a convertible note. It's not uncommon for it to also have a valuation cap to protect those early investors, but generally it's the same. Traditionally, it's associated with angel investors or very small angel groups whenever you're raising from high net worth individuals. So those are kind of the earliest rounds of funding. If you're just getting started, you don't know where to begin, I would recommend doing some research on either safes or convertible notes. And I would start by talking to high net worth individuals, angels, those types of folks. That's going to be your best bet for getting a round done relatively quickly. And if you don't know where to start, there's plenty of resources on Forecastr's website. We'll drop some in the description below. But that's kind of the earlier rounds of funding. Then you have what's known as priced equity rounds. These are the traditional rounds of funding where you do set a valuation for your company and you do agree to give X% of your company away to an investor in exchange for investing X number of dollars. Now, this is traditionally more associated with larger rounds of funding, with further down the line rounds of funding. And by further, I don't mean too far down the line. Usually around the seed round is whenever you start to hear about priced equity rounds. You hear about priced equity rounds in either the seed round of funding, or if you don't get a priced equity round during the seed round, you definitely hear about it during a Series A. Whenever you get larger and larger, investors want more and more sure terms that they're going to get on their investment. They have their ownership targets. They know what they need to have in terms of ownership whenever they make an investment in a company. So it's very important to later stage investors, still early stage, but relatively later stage based off this conversation, to know what they're getting into. So the thing about priced equity rounds is that you have to wait until the entire round is done before you can close those funds into the bank account and start spending the money. They can also be much more expensive to get done, meaning that you're going to have to hire a lot of lawyers. It's going to be a relatively hefty legal bill, at least most of the time, to get these types of round of funding done, because now we're talking about real tangible ownership, which has real tangible implications in the real world. And that's traditionally whenever lawyers tend to get involved. But this is a necessary evil, I will say, because again, investors, good investors, are going to need to be sure of their ownership terms. And even the folks that invested in the earlier rounds on the convertible notes or the safe agreements, they're going to be looking to have their ownership ownership terms shored up as well. So priced equity rounds do have their place in the world for those two reasons. So this is a very, very high level overview of the early rounds of funding. Hopefully this was helpful. Hopefully it was useful. We have tons of resources on Forecastr's website. We'll link other useful videos that I've shot in the past to hopefully give you some more context. But as always, we're going to be putting out more content around fundraising, about what to look for in fundraising, strategy for fundraising. Hopefully you found this useful. Comment below if there's something that I didn't touch on or something that you want to learn more about, and we'll be sure to put out more content and touch on all of that.